For 54 years, Southwest Airlines promised what no major carrier would: open seating, free bags, and no change fees. Then Elliott Management secured 5 board seats. Within months, every promise was marked for elimination, while Southwest's own research warned those changes could cost $1.8 billion in lost business. This is a $4 billion bet on whether Southwest can survive becoming the airline it spent decades refusing to be. On June 18, 1971, Southwest Airlines commenced flights between Dallas, Houston, and San Antonio using Boeing 737 aircraft. From those first departures, founder Herb Kelleher established an operating model designed to keep flights moving and keep costs low. The core of this system was the 10-minute turnaround, a speed advantage achieved by eliminating assigned seats. By boarding passengers in simple groups and letting them select any open seat, Southwest kept its planes in the air rather than idling at airport gates. This speed-oriented strategy worked in tandem with a simplified fare structure. While legacy competitors built complex networks of baggage fees and reservation penalties, Southwest offered 2 free checked bags and waived all ticket change fees. These policies functioned as a single operating system, rather than isolated perks. This universal flexibility applied across all tiers, including the lowest-priced Wanna Get Away tickets. The combined package allowed Southwest to run a highly efficient, high-utilization network, while establishing a distinct market position that legacy competitors using pre-assigned seat maps and fee-based structures could not easily match. For decades, this operational simplicity served as the foundation of the airline's customer loyalty and its low-cost business model. In June 2024, activist hedge fund Elliott Investment Management disclosed a major equity position in Southwest Airlines, initiating a high-stakes campaign for corporate reform. Elliott publicly targeted the airline's declining profit margins, arguing that Southwest had become a market laggard compared to legacy competitors like Delta and United. The activists' investment thesis focused heavily on UN-monetized demand, pointing to the lack of premium seating options and a low share of ancillary revenues as primary drivers of poor shareholder returns. Southwest Management defended its structure, maintaining that its operational simplicity and customer-friendly policies were deliberate, brand-defining strategies designed to secure long-term loyalty rather than oversights. However, as Elliott's position crossed the 10% threshold, the pressure to reform the airline's governance intensified. In October 2024, the two sides reached a settlement to avert a proxy contest, triggering a significant shift in corporate power. Executive Chairman Gary Kelly and 6 incumbent directors agreed to step down. Southwest then appointed 6 new directors to its board, including 5 nominees chosen by Elliott and 1 former Chevron executive. While CEO Bob Jordan retained his position, the agreement transferred substantial governance influence to the activist. What began as an outside campaign became direct boardroom power, setting the stage for an unprecedented strategic overhaul. In July 2024, Southwest Airlines publicly announced it would abandon its open seating model, replacing the first-come, first-served boarding system with assigned seating and a tiered cabin layout. This decision ended the operational strategy designed to maximize aircraft utilization through the 10-minute turnaround. The restructuring of the traditional model accelerated on March 11, 2025, when Southwest announced the end of its trademarked Bags Fly Free policy. Effective May 28, 2025, the airline implemented a mandatory fee schedule, $35 for the first checked bag and $45 for the second. Under the new rules, only Rapid Rewards A-List preferred members retain their 2-bag allowance, while A-List members and co-branded credit card holders were limited to a single free bag. All other passengers faced checked baggage fees for the first time in the airline's history. To segment its passenger base, Southwest introduced a restrictive basic fare tier. Unlike the flexible Wanna Get Away tickets, the basic fare was structured as non-refundable and non-changeable, restricting flight credit recovery windows and earning only 2 times Rapid Rewards points. This new tier removed the universal ticket flexibility that had characterized the airline's fare structure for over 5 decades. The operational changes extended to Southwest's internal structure. To align corporate expenses with this new strategic direction, The airline executed a workforce reduction, cutting approximately 1,750 corporate positions. This move marked the first mass layoffs in Southwest's history, targeting overhead to support the new operating priorities. This series of policy shifts culminated on January 26, 2026, with the departure of the last Southwest flight featuring open, unassigned seating. The completion of this flight marked the final sunset of the 54-year boarding tradition, leaving the airline with a fully assigned cabin layout and a fee-based service model. Southwest's strategic shift is built on a precise, high-stakes financial equation. To satisfy activist demands, management is targeting $4 billion in cumulative incremental EBIT, operating profit before interest and taxes, by 2027. A key pillar of this plan relies on capturing ancillary revenue, which is the money passengers pay beyond their base ticket price. Southwest estimates that the newly introduced bag fees will generate roughly $1.5 billion in new revenue each year. The airline is also pursuing a cost target of $500 million in annual operational savings. Wall Street immediately validated this path. Following the announcement of these policy shifts, Southwest stock climbed nearly 9%. On that same day, major competitors Delta, United, and American saw their stock prices drop by more than 11% each, as investors anticipated a more aggressive, yield-focused competitor. However, the mathematical model contains a major vulnerability. Southwest's own internal research warned that the airline could lose up to $1.8 billion in bookings from passengers who previously chose the carrier specifically because of its free baggage policy. While shareholders celebrated the immediate balance sheet projections, the actual outcome remains an active gamble between immediate revenue gains and long-term customer attrition. At the boarding gates, spreadsheet models confront human behavior. Frontline employees now manage passenger confusion over assigned boarding groups and overhead bin space, enforcing baggage rules and fare restrictions that did not exist during the airline's first 5 decades. Gate agents and flight attendants find themselves policing the cabin, turning the traditionally relaxed boarding process into a source of friction. This operational friction carries a direct financial risk. Loyal passengers, who once chose Southwest specifically to avoid these complexities, are starting to book flights with rival carriers. In commercial aviation, passenger loyalty functions as a protective economic shield, lowering customer acquisition costs and ensuring predictable repeat bookings. By adopting the legacy carrier playbook of bag fees, tiered fares, and assigned seats, the very practices Southwest spent 50 years mocking in its advertising, the airline risks dismantling the distinct brand equity that insulated it from industry downturns. The entire strategy rests on one major assumption: that Southwest can extract legacy carrier revenue without losing the operational distinctiveness that defined its brand. Early financial results remain mixed. While fee generation expands, boarding friction and passenger frustration threaten the repeat patronage that historically kept aircraft full. Shareholder optimism does not guarantee victory, and passenger resistance does not equal failure. The long-term test of customer retention and brand loyalty is only beginning. It leaves unresolved whether Southwest saved its balance sheet by becoming just another airline or traded away the single reason passengers chose it. Today, Southwest's high-stakes gamble is live. Adopting the legacy fees it once mocked creates a defining corporate paradox. Can the airline trade its identity for Wall Street margins and survive? The answer will redefine modern aviation. Join the conversation below.